For the latest insights into the Pridham Report, I'm joined now by its author, Benjamin Reed-Hurwitz. He's also Head of Research and Development for North America and EMEA at ISS Market Intelligence. Benjamin, thanks for joining us. I mean, looking over 2025, it felt like a pretty tough year for fund management groups. Sales were down year on year, all sorts of events in the markets holding investors back. On balance, do you think it was a positive year for the asset management industry, despite those headwinds?
So net sales was down, and net sales really represents how much the fund industry can win in aggregate. And we're looking at UK investor flows here. So it was a challenging 2025 for fund managers in the UK. But that's not really the whole story, and I don't think that's the story we should focus on or that many fund managers are focusing on. In fact, gross sales was at record levels, and gross sales really represents the opportunity that any one manager can win. And interestingly, even in this negative environment, we saw a lot of different managers find success. So if we turn to the Pridham Report, 55% of the fund managers participating in the Pridham Report actually saw improved sales in 2025 over 2024. So we had a negative sales environment. So on net, the industry did lose some money, but we actually had a lot of winners in that. So how did that happen? Well, gross sales were at record levels in 2025. Money was definitely in motion. And it was really in motion for sort of three separate reasons we're going to sort of talk about. So one, there's a transition in who controls the portfolio. Two, related to this, how portfolios are being constructed is changing. And then three, there's also a much more global mindset with investors. This isn't just the case in the UK, it's occurring in the other markets I look at. And what I mean by this is portfolios are globally benchmarked. But I think I would finish by saying 2025, from an investment management standpoint, was the year of diversification. Whether it was regarding rates and the future of inflation, whether it was looking at the economic growth prospects of different geographies, whether it was related to tax changes and how planning might sort of change in the UK, there was almost always a story. And many managers found one of these stories led to their success. So again, it was a year of diversification. That meant many things throughout the year, but this is definitely a big reason of why so many fund managers were able to win in an otherwise tough period.
Well, you mentioned there the new groups or new people of influence emerging in the market. So who are some of these new portfolio constructors? How's that changing the economics of the business?
So I say that the word of the year was diversification. The word of the decade is outsourcing. And one of the key areas we've seen outsourcing within the investment management business is from advisors to other portfolio managers. A big way this has occurred, one of the most prominent, is the move to centralized investment propositions, be it in-house or through a third party. But this has moved a lot of the fund selection responsibilities to different portfolio constructors as I talk about them. Now, one of the most prominent, the one that probably gets the most airtime these days, is related to model portfolios. So the growth of model portfolios, which now is sort of the predominant investment solution we see in our advisor platform data, that's led to a whole new sort of possibilities when it comes to portfolio management. And we've seen many new entrants. In our data set, for example, we have over 200 MPS providers. And many of them aren't the traditional multi-asset specialists, which would tie in much more to who we traditionally think of as a fund manager in the UK. So you've had this really growing and burgeoning multi-asset space. So in terms of outsourcing, unitized multi-asset funds, they also grew. So they grew along MPS, and now it's creating a real consolidation of flows amongst these portfolio constructors. And I think the way we now need to think about the business, think of investment fund flows, and luckily we use that word flows as like a river. So at the beginning of the river, the top of the mountain is sort of the client. And then comes the IFA or the wealth management firm. Then we've seen the development of sort of the platform if we keep following the path of the money. Now we have this much larger MPS and multi-asset now after the platform. And then we get to the investment fund managers. And why does this matter? Because these multi-asset players have essentially become the ones constructing dams in the river. Now they control the water and where the flows go. And that's led to a lot of the transition in money and is really creating a lot of these new opportunities.
Well, you mentioned there that there are some fund groups that were clear winners. The gross sales were high. So what are those fund groups doing that's allowing them to succeed, given this new emerging backdrop you're discussing?
So let's talk about how the portfolio has transitioned. So the portfolio has transitioned with many of these new allocators towards what I call a blend. There's a lot greater usage of active and passive funds. These portfolios are being built in a very value and cost-conscious manner. And again, it's about who can sort of fit now within this view. So what has it done? So initially, certainly leading into 2025, a lot of this money we see continual inflows into passive funds. When £1 of investment sort of moves from advisors selecting the funds in aggregate to these selectors, you can see a 20% change in the use of passive. So again, this has sort of been a transitory effect that's continued to drive flows in, where active management's generally sort of lost flows for a number of years, and there is this transition effect. But what this new portfolio is opening up is new opportunities. And two I'll mention, we're seeing a great growth again in sort of systematic strategies, enhanced index, and quantitative, because the new core of the portfolio is being priced at sort of a blend between traditional active and passive. Well, now solutions that combine both in one are going for the core. So that's one kind of new opportunity, and seeing a number of firms win off that. The other, though, is this has interestingly opened up more room for high alpha strategies. Because you have this lower cost core, there's actually a bit more space for sort of higher alpha, more outcome-oriented strategies. So absolute return is actually something we're seeing bouncing back because it can be a real diversifier, and there's a bit less price sensitivity in sort of that the diversifier bucket compared to the center. But again, tied to that, I mentioned a more global portfolio. Every market's now on the board. There's much more willingness to sort of invest across the board. And kind of very lastly, in this negative sales environment, we saw offshore funds sold in the UK actually have positive net sales and grew. And this is significant because, again, it just speaks to the diversification. The new portfolio constructors want as broad a shelf in general to pick from as possible. And again, that's why we're seeing more offshore. Obviously, there's still great solutions onshore, but there's great ones offshore. Many of these selectors just looking for choice.
Well, a lot of what we've been talking about so far is trends within the UK. As you said, it's very much a global environment. So what can the UK learn from other parts of the world?
So I think one trend connecting sort of many markets together is this idea of institutionalization of asset management, and specifically in regards to the retail space. So the UK is not the only market where sort of control of the investment solution itself is consolidating. And what this is sort of ultimately leading to is a move from being a sort of price or product maker to a price and product taker. In dealing with these larger partners, and we see a lot of partnership activity obviously in the UK, but you do see it in markets as well. This is getting to this maker versus taker. And more asset managers are having to really become flexible around sort of needing to be flexible on sort of product. So what do we mean here? This is, say, between a more traditional investment fund and an ETF. So in the US, we see some advisors, their practices have become much more ETF focused. We've often seen as one part of the portfolio goes to ETFs, the next will eventually follow. And it just means managers need to be very aware of who their target is and what strategy do they want. Because if they want ETFs, you might need to meet them there. The UK, we've seen a little more on pricing. You know, this sort of large multi-asset provider is looking to have their portfolio at this price. You need to fit within that. And it's creating this more open conversation, but also flexibility. Whereas in the old world and retail, asset managers used to sort of more just define the strategy at what price and what product structure. This has become a much more open and evolving conversation. So I'd say that's one big trend. The other is sort of to watch, especially in the US for many, kind of why people are adopting ETFs, what strategies they're adopting them for. And then it's the same kind of the active passive splits, because the UK is ultimately taking, in terms of active passive, a similar trajectory. And it's just learning about those behaviors. And again, learning about the different segments sort of within. Because the one thing I'd say we've talked so far in aggregate, there is really every type of buyer out there. And the most important thing is really segmentation.
What is it going to take for fund managers to win in this environment?
So I think number one, and this is really beyond asset management, I think we've seen this in many aspects of our lives, is I would say genuineness. I think the asset managers who know who they are, what they deliver, and really have conviction in their philosophy are finding plenty of opportunities to win. So one, I'd say, again, those who know who they are and can really communicate that are finding a lot of success. The second, though, really comes down to you need to be having the right conversations with the right firms at the right time. Obviously, a big component of this is the strength of your sales team, but there is a second component, data, and specifically segmentation. And that's really where a firm like ISS Market Intelligence comes in, because again, it's helping our clients understand what buyers show what preferences, and therefore what messaging to be ready to sort of bring to them. Because again, that right conversation is, again, needs to reflect the buyer's permission. I've talked about moving from a maker to taker philosophy, and part of that sort of taker philosophy needs to be that sort of open, honest conversation with clients, but also sort of an understanding their preferences. And that's what we can really pull out of the data. Because I'll emphasize again, there's a buyer of every type. The market's complex and wide enough, it'll be hard to talk to everyone. So make sure you're talking to the right firms about the right ideas. And again, that's really where data is helping some firms get ahead.
We have to leave it there. Benjamin Reed-Hurwitz, thank you.
Thank you.